Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. This man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Good.
Um,
You want to start with the disclaimer?
yeah. Good morning, everyone. And before we get started, keep in mind, Will and I am Market Chameleon. We're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker. That's what they're there for. There's the disclaimer.
Excellent.
And I'm going to share my screen. If you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it. He'll read it back to me. We're going to take a couple minutes to give you guys a chance to put in those questions. We'll take a look at the pre-market report that I'm on right now, see if we could get some insights on the pre-market trading. Then we'll move on to the questions. And I think I'm going to have to cut it off a little bit earlier today, Will. Taking the car in for service. So, unless we have questions, we might cut it off a little bit earlier today.
Hey, no worries, Steve. We appreciate any time you can give us. Thank you.
For sure. Okay, so let's start out with the pre-market report. These are stocks trading in a pre-market hours. Up here, we have a calendar view, which lets you go back in time, hit a specific date if you want to see the historical data, what happened in the pre-market hours on a historical date. Today, we're on January 4th. So far, this is what we're seeing. 473 stocks are trading higher in the pre-market hours, 278 stocks trading lower. As far as volume goes, we got 128 million shares trading on up volume versus 106 million on down volume. And if we convert that volume to dollar value, we got $1.5 billion worth of stock trading higher versus 1.3 billion worth of stocks trading lower. So just from that perspective, a little bit of maybe a bullish lean in the pre-market hours. If we look at this, the dollar value of the stock almost balanced out, but slightly bullish sentiment in the pre-market trading. Let's look at it from a couple more perspectives, and then we'll move on to questions. I'm going to scroll down here. And now we have three lists of stock symbols that are trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. To make this list, we do set certain thresholds for liquidity, price change, volume, and so forth, because things in the pre-market are illiquid. And we could see here that there are 55 stocks that made our biggest percentage gainers list, 43 on our biggest percentage decliners. So this also points to slightly more bullish sentiment in a pre-market. However, if you look closely at the symbols, and you'll see that there are small market cap stocks in there. We have ETFs. It could be leverage products, could be a closed-end fund. So anything that's trading in pre-market hours listed on the major U.S. exchange and meets our thresholds could make this list. To narrow down to a smaller group of stocks, we could use the filters above. If you have a watch list, you could filter by your watch list. We're going to use this filter in ETF. In our example, I'm going to click on it. You get a drop-down menu to select from. We're going to choose SPY, which is the S&P 500 ETF. But when you do that, the list below will get filtered by stocks that are holdings in the SPY ETF. And for some reason, let me refresh my screen. I had this up for a while. However, again, once we do that, I'll do that again. We are going to filter out the stocks that are holdings in that SPY ETF. And for some reason, my computer now is slow. There we go. And here we see 5 stocks made our largest percentage gainers list, 22 on our decliners. And from this perspective, we look like, that's actually gone the other way now, right? I think we're looking at some bullish signals now. From this perspective, looks like the trading in a pre-market is now leaning towards the bearish side. And yeah, and I'm just looking up here. I think I had this up for a while, that even when this updated, now things are looking a little bit more bearish. So we give it a couple minutes. Well, if you have a question, I'll take it now.
Nothing has popped up as of yet, D.
Okay. So really quickly, I think we had one come over email. It was in regards to how to screen for a calendar spread. So we don't have a screener like here. Here we do have, you could see a bunch of screeners for different types of option strategies. However, there are so many different option strategies out there. It's not possible to create a screener for all of them, especially for each strategy, there could be a endless amount of combinations as well, because once you start using multi-leg trades, you could combine them in many different ways, right? So because you have different strikes, and once you go cross expiration, now you have different strikes and different expirations, different combinations. So it's not practical to create 1,000 different screeners, for example. But I'm looking at the calendar one because maybe the most popular ones, maybe we will create a calendar one. But at this time, we do have an alert system, and that's on the home page. And the alert system can screen out or alert to some potential calendar spread ideas. And here you could, if you drop this down, right now the market is closed, so this only kicks in when the markets are open. It starts scanning the markets. But you could see here's a bearish calendar spread. So when you click on it, again, there's no alerts. The markets aren't open right now, so it's not scanning yet. It resets in the beginning of the day. But if the market was open and it scans in the background, and if it finds interesting opportunities, it will pop up the alert in there. Okay, and those will come up. So this one, a bearish calendar spread, would look for a time spread, a calendar spread, a put spread with that targets some downside strikes. If you wanted to look for a bullish calendar spread, then you could do it this way, and this will look for calendar spreads that are bullish. Okay, so that's what one way to start out, as if you just wanted to go find some potential ideas, trade ideas. And as a reminder, we are going to be doing a webinar on multi-leg trades, screening out for trades that are trading in the market, right? So these aren't screening for specific opportunities based on criteria. These will be actual trades that other people are doing that you could go and analyze. So if somebody's trading big calendar spread, let me see. So this tool that we're going to be doing a webinar on is not yet available. We're going to make it available right before the webinar. Okay, so we're still kind of working on it, but for Tuesday, we'll make it available, and it'll look a little bit different than, let me see if I could show you a preview. It's going to look different than this, actually, but the idea behind it is that it will scan out trades that are happening in the multi-leg trades. So here's like top 5 in coin right now. So I don't see a calendar spread in here so far. There's a diagonal put spread. So you can see here a diagonal put spread traded 2,762 times in coin. And this was a January, February, right? So this is going cross month, but it has 2 different strikes, the 160, 150 put. All right, so so you could see here that this same spread, this is the multi-leg spread. This same spread traded many times yesterday. So the same exact Jan, Feb, 160, 150 put traded, looks like 11/24/11, 11/29/52. So you could see here 11/20, 145 times it traded for total volume of 2,762. So these are things that we're going to be going over. This is not available yet, and it's not going to look like this. This is my test environment, but this tool will be available next week. We're going to push it out. So you'll be able to, I think, Tuesday morning. Okay, the idea is Tuesday morning, the tool will be available. Tuesday afternoon at 2:00, we're going to do a webinar on it, how to use the tool and what it means. Okay, so this is the idea. And then, if you click on here, you get the details of the spread. Once you click on this little details, these are the 2 legs. So you could see here the spread, the prices it traded at, bids and offers, and all that stuff. Okay. So that's another way to be able to kind of screen out calendar spreads that are trading out there, and then we could, you could do an analysis, a further analysis on existing, transact, because these are already people are already transacting in those particular calendar spreads. Real quick,
we did have a question from Rob. It came
okay.
in.
Okay.
He was asking if you could we had so many things. Will, can you please ask Dimitri to show us how a synthetic cover call is set up? Now, I know you have to leave early. I mean, we could set that up for tomorrow if you were going to show something really quick. We could save that for Rob for Friday if you want. But
so a covered call, right? A covered call is you're buying a stock and selling a call against it. That's what a covered call is, right? So when you're looking at a stock,
it's 1 for 1, right?
Yeah, it's 1 for 1. So let's just say, the 155 call, let's say, what is a covered call? Well, you sell this 155 option, right? So with the 155 call for 12.35, and then you buy 100 shares of stock, 1 for 1, right? If you have one call versus 100 shares, right? Because if the one contract is 100 shares deliverable. So this is what it would look like. That's a covered call, right? This is what, not the synthetic, this is the actual covered call. And when I run that diagram, what does that look like to you guys? And then what does that diagram look like if I expand it, right? Because if the stock goes up, you make money on the stock, and then once it goes above your strike, the 155 strike, the stock gets called away, so you're limited to the upside, right? So it's whatever you make on the stock plus the premium, and then if the stock falls, you lose money on the stock, and some of it will be offset by the premium that you sold the 155 strike. So if anybody is familiar with the payout diagrams, this looks like a selling put, right? That's what if you sold a put, that's what the payout diagram is going to look like. Because if you sold a put on the downside, what happens is it crosses your strike, you're going to lose. To the upside, if the stock rallies above your strike, the put will become worthless, and you keep the premium that you sold the put. So what is a synthetic covered call? Well, this is the covered call. The synthetic, which is basically the position that mirrors this, would be selling the put, right? So what is the synthetic? So keep in mind, this is what it looks like, right? That's what this looks like. So the synthetic is going to the 155 put, just selling the put, right? Selling the 155 put, 1440, calculate that. See? Diagram. So you basically replicate the same, risk exposure, right? It's a synthetic, it's an equivalent, right, to the covered call. And as a matter of fact, it would be, if those two diverge, it would be create a theoretical arbitrage. You still have to make sure, like, can I sell short the stock and stuff like that. But in theory, if everything, in a perfect world with your borrow rates, and you're able to borrow the stock and earn interest on it, and hold it, and all that stuff, you'll create an arbitrage between the synthetic and the actual. So the synthetic covered call is really just selling the corresponding put on the same strike. That would be this. Now the synthetic put, right? If I wanted to create a synthetic put, then we would do the opposite. Do the cover call, right? Sell the call and buy the stock. So these are two, positions, two strategies that mirror each other. They're the two equivalents.
All right, Rob says very helpful, D. Thank you very much.
Yep. One last thing, and I'm going to go. When we do calendar spreads, right? So calendar spread is when you do an option, let's say call spread, calendar call spread, right? It has two legs. You sell a call in one expiration, and then you buy a call in a different expiration on the same strike. So that's a calendar spread. So the calendar spread is really the idea of, using the same strike on two different expirations. Okay, and so instead of same expiration, two different strikes, you're using same strike, two different expirations. That's a calendar spread. Now, one thing to keep in mind is that as the time difference between the expiration grows, right? So if you're doing a calendar spread that's between January 26th to, like, let's say March 21, 2025, right? So it's from 23 days to, I'll go all the way out to March 21st. Why is my 443 days? I'm just using this extreme. It doesn't even have to be that extreme, but the idea is, as you go out further, 30 days, 20 days, 30 days, 40, 50, 60, the strikes, okay, that you're using, let's just say you're trying to get the at the money. The at the money strike in January 26th, right, is not really equivalent to the same strike going out to, like, say, June 21st. It's not equivalent because of the forward. You have to look at it as that the stock price today, okay, the present value, it's not the same thing as the forward price of the stock price like 5-6 months from now. And that's because it has to do with interest, right? So the present value is not as high as the forward value when you take interest into consideration or any dividends. So, there's a cost to carry. So there's a forward price. So today's price, of $150, right? It could be equivalent to $155 a couple months out, right? So if you're targeting, the at the money or the forward, it's if you're looking at the difference in the volatilities, right? If you're trying to get the difference in the volatilities of at the money options, then you're going to have to reference the forward price, the forward price of the stock, the underlying in that expiration, right? So that if you're trying to make that analysis, okay, of what is that at the money, right? Well, the at the money today and the at the money a year from now is different, and that's because of the interest rates and so forth, okay, right? So it's like thinking of a bond, right? If you have a bond and you buy it at a discount, well, the bond that once it matures in a year, well, it's going to be a different value in a year than it is today, right? So that's kind of to give you the idea of what a forward price means. So you would have to match up, and I don't have time right now to show you this, but we'll discuss it in future videos. Okay. All right. So I think I'm going to end it here, guys, because I got to drive and take my car in for service today. I got an appointment, so I want to get that out of the way.
All right. Awesome job. Sorry about that. Thanks for the questions, everyone. We will see you tomorrow. I did put a link to the registration for the IBK webinar in the chat. And DB, thanks for the nice comments about the library that exists on IBKR. He's gone in and gone through a couple of the old webinars. They all exist on Interactive Brokers website, which is very nice of him. Awesome job, Dima.
Thanks, everyone, for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade and peace, community.